Hello, my name is Dave Zapponi. I'm the CEO of ECHO, otherwise known as the Educational Council of Homeowners. Thank you for participating in this community conversation, HOA taxes and other accounting conversations. ECHO is a statewide nonprofit organization established to support HOA board members and engaged homeowners. Our mission is to foster a better quality of life in community associations through education, advocacy, and connection. For today's event, we have a few housekeeping items. These are now presented on the screen. In addition, slides were sent to registered attendees beforehand. Please take a moment to review our housekeeping items. We have many homeowners or HOA board members in attendance today, which usually means we'll have a lot of questions. We'll do our best to answer them. Please use the Q&A icon, not the chat icon, to ask your questions and make comments. You should use the chat icon to report technical issues and to communicate directly with other participants in the webinar. You will find the navigation icons by hovering over the bar at the bottom of the page. I will respond in writing to some questions in the Q&A feature during the presentation. All other questions will be answered after each section during the Q&A sessions. Please keep your questions general in nature. Questions about specific situations are better asked of the attorney serving your association or another industry professional familiar with your specific situation. To help us select the most relevant questions, please use the thumbs up icon found in the Q&A feature. Simply click the upvote icon to select your favorite questions. Please find on your screen our disclaimer. None of what is said during the seminar shall be construed as specific legal or expert advice from the speaker, sponsors, or ECHO. If you wish specific advice, we encourage you to contact your attorney or other suitable expert or CPA for the information. The information we provide during this webinar is educational in nature and should not be relied upon for specific decision-making purposes. Thank you. Today we have several sponsors. Please join me in thanking them. Our premier sponsor is the Kevin Boland Insurance Agency. Our registration sponsors are the Levy Erlinger and Company, LLP CPAs. Now we will have a few words from our premier sponsor, the Kevin Boland Insurance Agency. But unfortunately, Kevin is unable to present his ad at this point. So I'm going to say a few words for Kevin. First of all, Kevin has been a year-long sponsor of ECHO and has been at most of our events. He's a great man and person. He's on his HOA board. He handles many lines of insurance, and we ask that you give him a call if you have any questions. Our farmers insurance agent, Kevin Boland, one of our favorites. We also will be giving away one $50 gift card courtesy of our card sponsor, the Silver Creek Association Management. Please stay until the end of the webinar to have a chance to win. Thank you to all our sponsors. They make this event possible. Here's an introduction of our faculty today. Mila Krasnova, CPA, CGMA, is a partner at Levy Erlinger and Company, LLP, and CPAs. Mila has a graduate degree in economics and certifications in business management and QuickBooks. Her professional work experience includes accounting, economics, business management. Mila is also the co-author of the Condominium Green Book. Bill Erlinger received a BS in accounting from the University of California at Berkeley, his MBA in finance from Boston University, and a Master of Science in tax degree from the California State University at Hayward. Bill's thesis was on taxation of homeowner associations. Bill is also an active member of ECHO, including former chair of the CPA Resource Panel and a contributor to the ECHO Journal and ECHO Insight magazines. We'll begin with part one. Mila, please begin.
Thank you, Dave.
You're welcome.
Okay. I will be talking today about first engagement versus representation letters, because we have some confusions and pretty often board or management ask us, oh, I already signed one letter. Why are you asking me to sign something else? Okay, Connor, please next slide and next slide. I will start briefly about talking about services, you engage us to prepare audit or review or compilation. Sometimes we do agree upon procedures for specific purposes. And also we prepare annual budget reports. Next slide. To start our engagement, we receive request for proposal, looking to current financial statements, budget, last CPA statements. We suggest to association which type of service they will need. Next slide. Proposal letter, it's not very frequent communication tool we use. Mostly it's used for new clients and big scale association, because it's more detailed and it has bids for multiple services. Decision between audit or review might be done later by the board. Next. And beginning point of our engagement would be signed engagement letter. What is this? Basically speaking, it's agreement between HOA and CPA. Engagement letter states our services, their type, extent, limitations, timing, payment terms, and so on. Engagement letter is required for compilation, review, audit, and tax returns. We couldn't start engagement unless we have it, to avoid any confusion, to avoid any misunderstanding. What happens sometimes, like board sent engagement letters to few CPAs, and when our work done, sometimes we discover actually they change their mind and we're not engaged anymore. It would be nice to know ahead of we started, of course, but it happens sometimes. That means if you sign engagement letter, you should coordinate between the board and let other people know, like the president signed engagement letter already. That means treasurer couldn't sign another engagement letter with another CPA. It's, but in general, number 3 on my slide, who should sign? It's the board member, preferably the president or treasurer. Sometimes it's the manager, might be manager or person assigned by manager. Signing engagement letter doesn't change any relation between management and CPA, not change any obligations. But it is important, and you have to read it before you sign it to understand what services you will be provided. Because when you sign an engagement letter, you are accepting terms of agreement. And it would be beneficial as for management, for board. It states like what CPA's responsibility is, that we suppose comply with professional and ethical standards. And HOA, on their hand, agrees to cooperate, assist, and finally compensate our services. Okay, next slide. When we have signed engagement letter, or like our workflow a little bit, we send document request. You can see on this slide the list of required document. Basically, this is your monthly financial package plus cumulative general ledger for full year plus budget, and some additional information might be required. Next slide. For new clients, in addition to the first page, it would be prior year information, tax returns made before, prior CPA financials, management financials, reserve study, maybe CCNRs, and we require a little bit more minutes to get more information about new client. Next slide, please. When we got all financial information, we prepare draft of financials and tax returns, and you will receive our correspondence packet, which include transmittal letter, missing items. For audit, it would be audit missing items. Also, representation letter required for audit and reviews, our trial balance and journal entries. Of course, financial statements itself, it will be a watermark draft and tax returns. Almost all tax returns now we send with e-file authorization form and expect this form returned back to us. Next slide. And when we receive all requested documents, missing items, and signed representation letter, we issue final report, and we send you transmittal letter. If we change some financials, we will resend trial balance and journal entries, and our final report, which has our signature. Next. But the final report would be never issued unless we receive signed representation letter. And you asked to acknowledge that it's your responsibility, these financial statements. And to the best of your knowledge, you prove the statements is correct. Keep in mind that the representation letter states you confirm to the best of our knowledge and belief. It's not like absolute guarantee, but to the best of your knowledge. It's nothing to be afraid to sign off. But of course, you acknowledge that you read draft financial statements. Number two, that board member can sign, usually president or the treasurer again, and management agent can sign. And when we receive the signed representation letter, we will issue the final report. Next slide. Okay, here are the checkpoint. Who can sign engagement and representation letters? A, board president, B, board treasurer, C, general manager, D, management agent, E, all from the above, F, none from the above. Please vote.
Okay, I'll give them about 30 more seconds. Okay. About 5 more seconds. Okay. And here are the results on your screen.
Okay, very good. All from the above. The correct answer is E. Yeah, 69%. Very good. Thank you. Okay, next slide. And my final words on the representation letter, like few questions. Number one, does signing in alter responsibilities? No, it doesn't. It just affirms existing responsibilities and clarifies our traditional roles like CPA and board member. Number two, why it's important. It's not just another form to be signed, which you get in your package. It contains very important assertion. And keep in mind that owners, future owners, bankers sometimes, others rely on our report. And because of it, we must comply with all auditing and accounting standards for process and procedures we perform during our audit. Number three, what do we do with unfamiliar terms or phrases? It's the simple answer, contact us, ask us, and we will go through. But keep in mind that representation letter, it's not something like we invented. It's a standard document. Sometimes if a board strongly believes it doesn't apply to them, some paragraph or some sentence, we can modify or we can explain you that it doesn't change anything. Anyway, please contact us if you have questions. Number four, can we get the final report without it? No, we can't give clean opinion on our report unless you sign representation, because without representation letter in hand, we'll have to wonder if board has withheld some information or something maybe not right in our report. And now last question, can we sign it electronically? Yes, you can. Electronic signature is acceptable. Okay, next, this concludes my representation engagement letter part, and I will move to my other topic, operating versus reserve expenses, because it's also when we do our financial report, we come across sometimes the board decided this would be representation, that would be reserve expense, and they even document in minutes, although it's clearly operating expense. Or they decided, okay, we split 50% would be operating, 50%, and it based only sometimes on monetary point, but it shouldn't be. Okay, let's go through reserve and operating expenses. Next slide, please. The Davis-Sterling Act states, the board shall not expend funds designed as reserve funds for any purpose other than the repair, restoration, replacement, or maintenance, or litigation involving repair, restoration, replacement, or maintenance of major components that the association is obligated to repair, restore, replace, or maintain, and for which the reserve fund was established. Okay, previous slide, please. The first step we would recommend is to refer the association's reserve study. You know that every 3 years you're supposed to update your reserve study, and reserve components list would be based usually on four steps test, like it should be association responsibility first. Second, component would have limited useful life. Third, it will have predictable remaining life. And fourth, it will have above a minimum threshold cost, usually like 1% of annual budget. Usually it's big expenses. Like when repair or replacement project doesn't appear on component list in reserve study, but you know it's like it falls in this category, you should contact your reserve study preparer and let them know that this component should be added to your reserve study. It might be confusing with maintenance, like when, for example, significant repair of roof or fence or road proposed as a reserve component, it might be tricky. You have to ask if this work going to increase remaining useful life of this component or result in improvement of this component, like it will become like new. If so, it would be reserve expense. With replacements, existing building components, it's more easy. It's like very straightforward. It's replacement, it was component, you replaced, it's a reserve expense. Like example, if homeowners tells you they have a roof leak and you repair this part of roof, it would be considered operating expense. But if association replace roof, replacement of roof is reserve component. And finally, check on how often this expense occurs, like frequency of expense. Operating expenses, usually it's daily, weekly, monthly expenses. They scatter it through the year. For example, you replace light bulbs or sprinkler valves or some local concrete repairs or some minor plumbing repairs. It would be operating expense. But if expense combined into one big single event, like for example, every other year you do tree trimming and tree maintenance, very expensive lately. Or you paving 10 sidewalk areas every year, repiping some section, it would be reserve expense. Next slide, please. Okay, there is example of operating expenses. Pretty often it's all contracted services like landscaping, general maintenance, property management, security, insurance and taxes, utility, office expenses, accounting, legal fees, other professional fees. Next slide. And few examples of reserve expenses, roof replacement or uncommon area buildings, new pump at the community pool, new playground equipment, replacing of fence, painting association buildings such as clubhouses, major landscaping projects, construction, major renovation such as sidewalk. Next slide, please. And I would like to add more confusion to you. What happens if some new component introduced to the community? For example, the association decided they want to install a spa, which they didn't have before. This project, once installed, will create operating expenses and future reserve expenses. It's not neither of them so far. It will be capital improvements expense type. The rule of thumb that for capital improvement projects, you should obtain membership approval before undertaking, and you should decide on funding. Where did you get money? Or you borrow from operating, or you do special assessment. You need to reallocate existing funds to pay for this component. Later, this component will be added to future reserve studies, and it will be funded through reserve. Okay, and this slide, you can see some examples of capital improvement, like addition a new fitness center, for example. It is clear example of capital improvement. Or if you decided to convert tennis court to pickleball court, it's also capital improvement. Remodel of existing clubhouse restroom, it's clear reserve expense. And upgrade of computer system, you might think it's capital improvement, but no, since you had already computer system, upgrade would be also reserve expense. Next slide. Okay, next, like a checkpoint, we will go, what type of expense is roof repair? A, operating expense, B, reserve expense, C, capital improvement, and D, it depends.
Okay, we'll go ahead and give them about 45 seconds for this question. Okay, and here are the results, Mila.
Okay. It's scattered. And majority told operating. This question was tricky. My answer, it depends, because it wasn't specified roof repair. It might be either of them. It depends on which part, and like it might be capital improvement, reserve expense, and operating. So it was okay.
Okay, so you got a trick question there, huh, Mila?
Yes, to keep you
Okay.
awake. And okay, yeah. I would conclude by telling that the board responsible to protect the interest of association and categorizing expenditure between operating reserve, it should be a careful decision. And correctly doing this, it's very important. You will keep financial stability of your association. And since it's such unobvious, if you're in doubts, you can always contact us and Reserve Study Prepare, and we will help you.
Sounds good.
Okay.
Well, we're going to go into a question and answer session with Mila right now. And I want to say thank you to Kevin Boland for sponsoring this session. Remember to use your upvote, your thumbs up vote on your Q&A feature there. And that will help us prioritize the questions. We don't have too many in here right now, so we ask you to go ahead and do that. And then I believe Bill and Mila will address some of these questions. So go ahead and Mila, if you want, let's take 2 seconds here, let people vote on the 5 questions we have. And then I'm going to, in the upper right corner, we'll go to the most upvotes on your screen. And that will put them in order of which one is most interesting to the audience. Okay, and the first one here is from Paul Congdon. Is the reserve study, hold on a second here. It
Disappeared.
Okay, is the reserve study
Okay.
a reserve expense or an operating expense?
Oh, this is a tricky one. In our opinion, this is clearly operating expense. But since sometimes the reserve study prepared put it on reserve study like reserve components, you might follow reserve study and treat it like reserve expense. But by the nature, it's operating expense.
Well, isn't the key to make sure you're consistent?
Right.
You're in and you're out.
Yeah, it's a good one. Yes.
Okay. Let's take a look at the next one. Where are capital improvements paid from?
Capital, I covered, I believe this. It's paid from if you have enough money, either in operating and reserve, you can board can decide and vote and borrow from either fund. Or if it's not enough money and it's big problem.
Whoops, something happened to your sound there, Mila. Let's do a sound check. Camila, can you say something? Okay, Bill, you might have to take over to answer the questions. Mila, your sound went out.
The capital improvements, it generally that term is used as an operating expenditure. You know, it's kind of it's a cloudy expression. Capital improvements kind of implies that major components, but usually as that term is used in governing documents, and we look at a capital improvement is for something that is not, that would be a major component had the developer put it in the association, but since they did not, it's a new component, then it would be an operating expenditure, and its replacement in the future will be reserves.
Okay, that's good.
Okay.
You
Oh.
back? Okay, thank you.
Can you hear me or still not?
You know, you're good. You're good.
Okay.
Okay. So Elise asked the question here. You want to address that? Do you have any recommendations for addressing significant differences between reserve fund allocation versus actual cost when it is time to repair and replace? For example, since COVID, plus supply chain challenges, et cetera, inflation, actual costs seem to be consistently 2 to 3 times higher than what we have in our reserve fund. So how do you deal with that? Big question.
Yeah, if your reserve study are outdated, definitely cost, at least you should inflate the projected cost by inflation rate to make approximate estimated amount.
Okay, you're having the same problem with your microphone. We can't understand it. So I'm sorry about that.
Okay.
William, Bill.
Bill,
Yeah.
it sounds like that the reserve contribution has nothing to do directly with the costs to replace major components. It's just that's a funding matter. So with the reserve study, you should update it. Even though the Civil Code says every 3 years a visual inspection needs to be done, you should have that study updated for the passage of time each year. So at the next as the next year reserve study update, it would be addressed the fact that costs are much higher than they were originally estimated or estimated a year ago. So I hope that answers the question.
Mm-hmm. Well, we had several reserve study questions come in the last few weeks, and we're seeing that the reserve study analysts are missing the mark quite a bit. So there needs to be some significant oversight of how things are changing in the industry. And so the board needs to be diligent in questioning how the expected future costs are escalating. And so it does require a little bit more involvement, especially during the COVID time. So this is a question of forecasting methodology. You need to stay on top of it. Okay, Terry asks, what happens if the reserve fund is depleted due to unforeseen work required? Would such an unforeseen charge basically become a special assessment in this case? Example scenario, if we had to replace a roof, but we're not prepared for that cost.
Yes. I don't know if you could hear me. It would be special assessment.
Yes. Okay. So let's go ahead and do the next one here. Does an HOA get charged for asking CPA questions? Is that the depends answer?
Yeah, that's true, because we don't charge if it's a short conversation and straightforward. But if it's going back and forth or our conversation, like meeting 1 hour, yeah, we will charge.
Okay. All right. Who pays property taxes on common areas?
No. Indirectly, Each owner does. The association should not be paying property taxes at all. And if so, please contact us or your CPA to get that resolved. Sometimes though, there's the misconception because it's not property tax you're paying, which is the ad valorem tax. It's a parcel tax, which is based on the lot. And that's a different matter, and that the association's obligated to pay. But if it's ad valorem tax, there should not be that at all. And it's just a matter of letting the county know what's up, and they'll remap it and the tax should go away.
Okay, so why don't we take one more question here. Let's go to the top here with John Moore. Replacing windows in our 4-unit building happens somewhat sporadically, but is fairly common over the years. When it occurs, it is very expensive. We treat this as a reserve item, even though it is hard to come up with a usable life for windows in aggregate in the reserve study, which we do ourselves. Any thoughts? So they do their own reserve study. How do you come up with a estimation of the 4-unit or the window cost?
We don't.
Yeah.
Reserve study prepared us.
Well, they do their own reserve study, so they're going to need. What they're asking is, how
They're doing.
can they project those costs?
Contact the vendor, ask the cost.
Yeah, there are escalators. I worked for Deloitte and Touche back in the old days, and there are escalators that you can use that are online now. They weren't then, and those escalators on the Consumer Price Index, and there's some probably for that sector that you can use if you want to estimate the cost of the product, and then of course the labor costs. Again, it's a shot in the dark, so it's going to be a continuing revolving process. You need to we used to call it a rolling forecast. So you just need to do a rolling forecast, and that's why you prepare your reserve study every 3 years, but you have to look at it every year, and you need to use that process. But looking at the methodology is critically important, and I think a lot of folks, like in the reserve study, they like to forecast out using a linear equation. They use linear forecasting opposed to sort of a curvilinear, which is maybe getting a little too technical here, but estimating that some sectors are going to grow faster than other sectors in terms of inflation. So do your best, the best you can. As long as you use a consistent methodology, I think you're in good shape. What do you guys think? Is that okay? My expert? that's what I would.
Yes.
Yes.
All right. So shall we go ahead and move on to Bill's part of the program here? And let me give you your introduction. Part 2. Those are great questions, great comments. Thank you so much. Sorry about the sound problems. We're going to go into our part 2 program. And Bill, would you mind go ahead and taking it from here?
Thank you, Dave, and good afternoon. There's 3 definitions of CPA. It depends on who you're asking. If you ask the Board of Accountancy, it stands for Certified Public Accountant. If you ask my wife, she'll give you 2 answers. One, she's a hairdresser, so she'll say it means cuts, perms, and answers. Or if she's talking about me, it's called constant pain in the arse. So there you go. With that, I'll kick off the topic here. Hard to imagine getting passionate about income taxes, but that's just the way some people are wired. So the recently enacted federal legislation, it's confusing. It's called IRA, which I always thought it was Individual Retirement Account, but it also stands for Inflation Reduction Act. And some of you may think that there's something called Alternative Fuel Refueling Credit. That's a mouthful. Also known as the Electric Vehicle Charging Station. I'll just get to the bottom line here. Don't even think about it. It only applies, it's available if your association is in an urban area. And that definition of urban area comes from the Department of Commerce. So probably most of you listeners here are in an urban area, so you're not going to be able to get any sort of credit for installing electric vehicle charging stations. I'm only the messenger. So next slide. There is something in the IRA that applies to an HOA, and that is the increase in the federal tax credit from 26% to 30% for solar energy equipment that is installed in an HOA. So how exactly is this credit going to trickle down to somebody? And I'm going to tell you, it does not trickle down to the homeowner association directly at all. I'll explain that in a bit. But let's start out with paying for the installation. It's an operating and not a reserve activity. That's because, as Mila pointed out previously, it's not an existing component. So you can't use reserve money on a component that doesn't exist. It has to be operating, which implies that you're going to have a special assessment in order to pay for the work to get done. In the year that the work is completed, the HOA notifies all the owners in the association of their share. That's tricky. Their share of the qualifying expenditures. And then each owner claims the credit on their personal tax return. So I have an illustration here of a simple, if there is such a thing, a simple homeowner association, where the installation cost of the solar energy equipment was $120,000. And all the owners paid for this by a special assessment. Now, all assessments are divided equally among the owners. So each owner, whatever their assessments are, they paid a special assessment, we'll say $10,000 each. So the $120,000 of the installation cost divided by the number of owners, 12, gives $10,000 to each owner of their allocable share of the solar energy equipment. Now, if the assessments are divided on a fixed percentage among the owners, then that also is a simple mathematical exercise. However, if assessments are divided on a mixed basis, then you should discuss this with legal counsel as to how this is going to get divided among the owners. So here, in this example, each owner is allocated $10,000, 30%, so they each get a $3,000 tax credit on their personal tax return. Okay, next slide. Thank you. There are two other ways to accomplish the purchase of the solar energy equipment. The second one is you get a third party who does this work on behalf of the association. Why do they do it? Well, they get the tax credit, not the HOA. But because they get the tax credit, there's some reduction in the cost that would otherwise be paid by the HOA for this solar energy equipment. The equipment gets installed, the HOA pays for the electricity at a lower cost to this third party, and they also make a monthly lease payment to this third party. Usually after some period of time of 5 to 7 years, there's a buyout provision in the lease where the association makes a lump sum payment to this third party, and thereby they take over ownership, and they don't have to pay this third party for the electricity. The last way this could get accomplished is the same as this other one just above, where the third party does the installation and the HOA pays the third party a lease payment and for the electricity. However, the HOA at no time ever exercises a buyout provision. So for the life of the equipment, the HOA pays this third party a lease for the equipment and also for the electricity. Which leads me into our first polling question. All right, which of these three methods is the most widely used? Is it The association pays for the work. The third party pays for the installation and the HOA later on buys the equipment? Or is it the third party pays for the installation, that the HOA never buys the equipment? Your guess here, please.
Okay, Bill will give him about 30 more seconds.
Thank you.
Okay, and here are the results.
Well, it looks like the 20% is wrong, is the right answer. It's most of these installations are where the association is a third party, do the installation, and then they buy the equipment after 5 to 7 years. I can't tell you the reasons why they do it that way, but that's the usual answer. So nice try, and thank you for the guessing. Next, okay. Now this is not really a tax piece of information. However, it's something that I've seen overlooked so many times that I believe it's certainly worthwhile bringing up. And that is, if your association is in the 9-county Bay Area, don't ask me what the counties those are, but that's what they call it. There's an organization called BayREN, and BayREN will pay your association up to $750 per unit if you install energy efficiency equipment. There's also some water saving equipment that's eligible, but let's talk about energy, the energy efficiency one. There was an association, there was a high-rise condo in San Francisco. So what they had 90 units, and they replaced their roof with some qualifying energy efficiency material. I think it was, anyway, whatever it was, but it qualified. So you can multiply this out, $750 times 90 units, they got $67,500 back from BayREN as an offset to the expenditure to replace the roof. And by the way, this is not taxable. So if you haven't heard about them, you should take a look at them, because this is found money, and it's so easily got. But as I say, I have not seen it used very often. It's called BayREN, and that's their website. So okay, I think we're coming up to a polling question. And that is, when you are asked by your bank or a government agency or your neighbor whether your homeowner association is tax exempt, what's your answer? Yes, we're tax exempt. No, we're not tax exempt. Maybe, I think I better ask my manager, or I don't know, I'll need to ask my manager. So the clock's ticking, and we'll wait for the results.
Okay, Bill will give him about 30 more seconds.
Sure.
Okay, and here are the results.
Well, I see some of you have been around a while, and the answer is no. That's the correct answer. Your homeowner association is not tax exempt. I'm only the messenger, but you're not tax exempt. And to To quote a former franchise tax board exempt unit executive, quote, nonprofit does not mean tax exempt. So with that said, we'll talk about HOA taxes. Okay, so at the federal level, also applies to the state, but we'll see at the federal level, let's say what income is taxable. Now, the first one is bank interest, as contrasted with late fees and late interest from members. So bank interest is taxable. Income from Comcast or AT&T when they pay you that lump sum payment for easement or access to your property. Rental income from association-owned property, and other non-member income that you can figure out what non-member income is. Now we know what income is taxable, what income is not taxable. And that is assessments and special assessments, late fees and member interest, and other member income, such as for the use of the clubhouse or things like that. That income is not taxable. Now, what expenses are deductible? Meaning that what expenses can be deducted against taxable income to come up with taxable income. All right, I think that was kind of a confusing sentence, but so what expenses are deductible? Any expense that's directly related to the production of the taxable income. In other words, if there's rental property and you pay somebody to clean out the property, that would be directly related to the production of that taxable income. And the fee to prepare tax returns. It's not a great amount, but anyway, it's a deduction. But what expenses are not deductible? And that's everything else. Now, the tax rate for federal returns on Form 1120 is 21%. It used to be at a graduated rates of 15% and so on, but that changed about 5 years ago. It's now a flat rate of 21%. Next slide. Thank you. You might be familiar with something called Revenue Ruling 70-604. This applies to the Form 1120 and also California Form 100, but the Form 1120. The reason this is called Revenue Ruling 70-604 is because in the year 1970, in the 604th Revenue Ruling, there was a pronouncement by the Internal Revenue Service of an interpretation of excess assessments. Now, when an HOA's members, well, let me back up. This has to do with only Form 1120 and not Form 1120H. Form 1120H, the election of the revenue ruling is not necessary. But on Form 1120, we'll talk about the reasons why you'd rather do it this way. The revenue ruling must be made by the members. It cannot be made by the board, and it cannot be put in your governing documents and make it effective. So it must be made by the members. At a member meeting, it does not necessarily have to be quorum. It's just be a member meeting. It can be accomplished by putting it on a ballot. It could be accomplished by a raise of hands by those in attendance at the meeting, or it could be by voice vote for those at the meeting. There's a sample wording you should use, and you can get that from our Condo Green Book, the 2021 version. There's a link. I think we'll talk about that at the conclusion of the presentation, how you can get that. So I mentioned Form 1120H. That's because the revenue ruling is not necessary, but there's drawbacks to Form 1120H. The most obvious one is that the tax rate is higher. It's 30%, not 21%. Also, the tax base is much broader. What I mean by that is that there's more income subject to tax on Form 1120H than Form 1120. Examples would be laundry income, which is member income on Form 1120, but it is taxable income on Form 1120H. There's controversy, rather late fees and member interest are taxable on Form 1120H. So there's more income that's subject to tax. Also, believe it or not, Form 1120H cannot be e-filed. It must be paper filed. Don't ask me why, but it cannot be e-filed. Now, for some of you out there, you internet mavens that go out there and internet search everything, maybe you've already internet searched Revenue Ruling 70-604. And let me tell you that myself, I just can't seem to put stuff out on the internet very well. So what you're going to find when you see a search on 70-604 is the opinion of a colleague who has a difference of opinion with myself. And that's Gary Porter, who's a CPA in Southern California. And Gary's opinion is that the 70-604 election can only be made once in an association's lifetime. And I respectfully disagree with him. I believe it can be made each year. So anyway, I thought I'd skip ahead and get to you those internet searchers out there who are going to look on the internet and see what's out there. You're going to find Gary Porter's opinion, not mine. Okay. Next slide takes us right into a polling question. Which of these three agencies has the most interaction with and the most power? I mean, power you can get when I'm driving at. What power over your association? The IRS, our Internal Revenue Service, the FTB, the Franchise Tax Board, or the Secretary of State, SOS, or you don't know. So we'll hear the results shortly.
Okay, Bill, about 30 more seconds.
Sure.
Okay, and here are the results.
Oh my goodness. My goodness. I'm very, very surprised. Let me tell you, hands down, Franchise Tax Board. Absolutely. Don't even think about IRS or Secretary of State. It's always the Franchise Tax Board. And we'll get to that right after we close this slide here. Great. Okay, now I told you it's the Franchise Tax Board that rules the roost here out of any agency whatsoever. And let me tell you, with the Franchise Tax Board, the point of pain or triviality is pretty much anything more than $1. Anything more than $1 that the association owes the Franchise Tax Board or the Secretary of State can result in suspension of the corporate status, revocation of the corporate status, even the dissolution of your corporation over $1. As I say, there's nothing too trivial with the Franchise Tax Board. And the Franchise Tax Board can also revoke exemption. I'll explain the pluses and minuses and what's that all about in a moment. So that said, I'm telling you, it's the Franchise Tax Board that is the most important agency, federal agency or state agency that has anything to do with your homeowner association. And it has the power, basically it's because it has the power to suspend the corporate status. It just tells the Secretary of State, suspend the corporate status, and they do it. So speaking about tax returns with the Franchise Tax Board, there is no Form 1120, Form 1120H equivalent. There's just Form 100. There's also Form 199. That's only if you have exemption from the franchise tax. We'll talk about that in a moment as well. The tax rate in California is 8.84% of the same income that's subject to tax on Form 1120. That's an overstatement, but that's pretty much how it goes. Now, if your HOA is incorporated, and most homeowner associations are incorporated, it is subject to the annual $800 a year minimum tax, just like every California incorporated association, every California corporation. So it's an $800 a year fee that you compute your tax. And if your income tax is more than the $800 you pay, the more. If your income tax is less than $800, you pay the $800. So that's how the minimum tax goes. In Revenue Taxation Code 23701T allows a tax exemption for most homeowner associations. But what is meant by tax exemption is merely that your HOA is no longer subject to the $800 a year minimum tax, and that your association must annually file Form 199. There's some other benefits for having exemption from franchise tax, but for the most part, this is all it's about. So everyone gets pretty worked up thinking about, I lost my exemption, the franchise tax board took away our exemption. It's just that you're now subject to the $800 a year minimum tax. Now, many associations, and I'm sure most of the people listening today are in associations that are in good standing with the franchise tax board, but for many that aren't, and believe me, there's very many associations that have had their corporate status suspended. The method, the quickest way to get back into good standing, the quickest way is to revive, that's the word, revive the corporate status as a regular corporation, not as an exempt corporation, because it takes up to 8 months if you want to try to get exemption from franchise tax and revive the corporate status that way. If you revive as a regular corp, it's probably 2 weeks, maybe a month, but you're subject to the $800 years, and maybe it goes back 3 years. But after you get revived and your corporate status is in good standing, then you go apply for exemption. And 8 months later, when you get your exemption approved, the $800 a year going back 3 to 4 years will be refunded. So to me, it seems like a no-brainer, but anyway, I'm giving you the phone number for the franchise tax board exempt unit. And this number should be high up on the list of numbers to save, because the franchise tax board issues notices all the time about you didn't file this, you didn't pay that, something bad's going to happen to you. And all you need to do is you call up the franchise tax board and they'll tell you what's wrong or how you can cure it. And believe it or not, if a CPA calls the franchise tax board exempt unit, they're not going to get the same answer a lot of times that you as a manager or you as a board member would. An example would be if the association lost exemption. If I call up the franchise tax board, they're going to tell me you've got to file Form 3500 again and wait the 8 months. However, if a board member calls or manager calls, they're much more sympathetic and they may just reinstate the exemption, maybe even the corporate status. If you are nice over the phone, you know what they say about vinegar and honey. If you talk with the exempt unit at the franchise tax board, you may get something that you didn't really think you could, and that's definite that if a CPA calls them, they're not going to get. So there's that phone number, and they're open from 7:15 to 4:15 Monday through Friday. Great number to call with any question about your association. So with that, my presentation's concluded. Maybe we get Q&A.
Okay, yeah, we're going to be taking some questions. We have plenty of time to, maybe 15 minutes or so to go through questions. And we have a lot of questions in here now. I've been trying to answer some of them. So we're going to ask people to just take a little break and a breath, and then go to the questions and upvote on your favorite questions that you would like answered. And then we'll turn that over to Bill and Mila to address. And our question and answer period is, of course, sponsored by the Kevin Boland Insurance Agency, a farmer's agency, and we thank him for doing that. So let's go ahead and, if you could, do your upvotes, and I will push the button at the upper top right-hand corner, Bill and Mila, you can see it. If you push the most recent, And you push the caret down, it'll say most upvotes. Okay, let's take a look at anonymous attendee. If the HOA installs conduit for EV charges in the building garage, would that be from operating expenses?
Yes.
It's pretty clear. Okay, thank you.
They don't have, unless they already have EV charging stations, which sounds like they probably don't, but maybe they do. And if they already do, then yeah, then right, the conduit would be a reserve expense. But if they don't, it's an operating expense.
Okay, so that's a nice quick one. Here's another quick one for you as we get the upvotes going. So gardeners are tax deductible?
Ooh,
Are gardeners tax deductible?
what's the gardener doing? I mean, is the gardener trimming the rental units, lawn and trees, or is if you don't have a rental unit, then there's nothing in the that you're paying the landscaper, the gardener, that's going to give you a tax deduction.
Gotcha. Okay, let's go to John Moore's question here. There are 4 upvotes, which is pretty good. Can you go ahead and just read that, and you see it there? Our accountant long ago advised us to pass an annual resolution stating it is resolved to accept the results of operations for the year ended, whatever the year ended. All contributions to capital are to be held in trust in a separate savings account. And ends, the board of directors is hereby authorized to add such excess funds to the following year's operating budget. Why do we do this? How, can you be a mind reader on that one, Bill?
Oh, I think the person, their accountant touched on a lot of the points. It's a pretty good resolution. Well, yeah, I think it's the revenue ruling 7604 election kind of on steroids. It's pretty good. It addressed, it's the reason you do it is, as I mentioned about the 7604 election, it allows the association to only pay tax on Form 1120H on non-member income.
Okay. How does it relate to our tax status? I think you just covered that. Is it still a requirement?
There's never a requirement because, well, let's just say you should do it every year. It's highly recommended. So, you know.
Okay, that's good. Well, we appreciate that. Let's go to the next question. Lisa Prey. For the residential solar energy tax credit, does this apply only to associations installing solar energy on residential buildings, or can installing on a standalone clubhouse also qualify? I presume that's a common area clubhouse.
Yeah, it is. Yes, it's any association property, any common area. Yeah.
Okay, so that's good. Thank you. Fred Kohler asks if an adjoining property has deeded right to parking spaces in an HOA garage, is charge to adjoining property taxable?
This sounds like a client.
Sounds like a client. Huh?
Oh, no, it sounds like so. Adjoining property is deeded right to parking spaces in an association garage. Is the charge to the adjoining? They're not members. The money that, you could say they're reimbursing your expenses, but you'd have to, the expenses may be allocable against this income, but the income is not from a member. So it's taxable. As I say, that, yeah, it's not from a member, even though they have there must be some agreement somewhere that says that they have the right to the easement to these spaces. That does not make them members of the association.
Okay. All right. Anonymous attendee asks if the HOA installs conduit for EV charges in the building garage, would that be an operating expense?
We answered that.
Oh, we did? Okay.
Yeah, an operating expense. Yeah.
Okay, so that one's done. Are HOA tax returns, federal and state, available to homeowners for review?
I would defer that to legal counsel.
Okay,
I don't think it's, they're not for regular disclosure. I mean, it's not, it doesn't, the civil code doesn't require that they be disclosed and sent to the owners. But whether owners could avail themselves of it or not, I really would defer to legal counsel's opinion.
okay. Okay, I do know that as a 501c6, we're required to have our returns available, so.
It doesn't matter. It's a 501c anything. It's available on the internet.
So it depends on your business type and a lot of questions. Defer to our legal counsel there. How do we know if we are in good standing with the FTB?
I'd take a look at the Secretary of State's website. That'll tell you right there. Look under, in fact, we all here have it. It's a quick link. Absolutely. You can look at the Secretary of State's website, you put in the corporate name, and it'll tell you in good standing or suspended. And if it's suspended, it'll tell you who's suspended. If you're suspended by the Franchise Tax Board, the Secretary of State, or both. So that's the Secretary of State's website.
Yeah, and of course you have your tax returns too for the FTB, right?
Yes.
Randall, what is the difference between an unincorporated HOA or tax filings?
None.
There's no difference. Okay.
No, there is no difference at all. An unincorporated association has the tax attributes of an incorporated entity, so it's the same tax returns. The issue falls over into the Franchise Tax Board area, where an unincorporated association does not have to pay the $800 a year minimum tax because they're not incorporated.
So are they treated as a partnership or what?
No, it's a corporation.
As a
Absolutely.
corporation?
Yes, they are.
Okay.
Yeah.
Okay, if an association has PPP solar panels and I don't know what PPP stands for,
PPA.
panels. Do you know what that stands for? PPP solar panels? Prepaid, I don't know. You might text that to us anonymous so we know what that means. And the agreement is 20 years with the option to purchase after 7 years is the agreement to purchase the solar energy produced. Purchase the solar energy produced considered a liability on the audit report. So liability, I guess we need to know what PPP is on.
That's it. The lease that falls within new GAAP, but the requirement to purchase electricity, and I'd have to look at that. It's possible.
Yeah. So let's go to Sean. Guessing how much balcony inspection is really off also. So he's trying to figure out how to guess balcony inspections. Vis-a-vis, I assume the reserve study, is that?
I guess I answered partially. It was first part of the or second part of this question. I answered this.
Okay. Okay, what about non-corporation HOAs? I think we answered that one too, right?
Sounds it.
Okay. Oh, let's talk about what does FASB ASC 606 refer to? And can you talk a little bit about what the requirements are, please?
Oh, it's a big topic. It's revenue recognition rules, new one, which we have disclosure in our financial statements, and we have reconciliation, budgeted revenue basically to actual reserve expenses, like speaking in plain English, you match reserve revenue to reserve expenses.
Okay, so it's revenue, it's a new revenue recognition.
Right.
Policy, and so that's basically what it is. And associations must comply with this new gap. I guess it's at a FASB. So, right?
Right.
Okay. Do we want to explain any more about it, or are we good?
Oh, it's a big topic. We can.
Okay. Okay.
We can do next ECA.
Okay. Okay. Yeah, it's a big topic. I know we touched on it last weekend at the financial seminar, and it took a while. Let's see. Next question here from Angelica. If several HOA members want an EV charging station, are all HOAs in California required to install an EV charging station? Since it's an HOA expense, how does the HOA determine how much the EV owners pay for the extra electricity that is used? First of all, there's nothing in the code that I know of, and this is not an accounting question, that forces you to put in an EV station. So that it has to be it has to be a vote of the community to do that. So you guys can answer the rest of the accounting question side of it.
I'm trying to think about how any associations have addressed that extra electricity. I mean, personally, I think how much electricity could there be that you're going to get all worked up about? Maybe the easier thing is just to decide, well, settle on $50 a month as a reasonable amount and just leave it at that, rather than to try and come up with an exact amount each month. But that's, that's just a personal opinion.
Yeah, it's hard. We have a number of senior citizens that are on fixed incomes, and they like their Cadillacs and that gas guzzling Cadillacs, and so they're happy to not vote for a EV charging station. And you think about it, that's probably fine for them in their personal situation. But there are others that are forcing the issue, and it's starting to cause some conflict in communities. So this is a really good question, and I think it really depends a lot on how the community decides to deal with it, and how fair they want to be. Stan is talking about if a non-resident board of director travels to meetings, is the mileage and tax deduction for personal income taxes. If they don't live in the community and they drive to the community to have the meeting.
That sounds like a personal income tax question. That's kind of, that's beyond the scope of our expertise here.
Okay. Yeah, that's probably true. Okay, let's go to the next question here. Does a small association that only has income from assessments have to pay the $800 per year? Can you explain again when it is required to pay the $800 minimum tax?
All right, if your association is incorporated, like all California corporations, it's subject to the $800 a year minimum tax. However, if your association is primarily residential in nature, that means you can get exemption from the requirement of $800 a year. But in order to do so, you have to apply on Form 3500. It's a one-time application unless you run afoul of the Franchise Tax Board and they yank your exemption. So you have to apply for exemption, takes about 8 months. And then once approved, you're not subject to the $800 a year minimum tax. And the approval is retroactive, generally 3 to 4 years. So if you pay the $800, you'll get it back unless your income was more than $800 taxable income.
That's good. All right. So let's go to Casey. I'm going to go to Casey real quick. Are all roofing expenses those of the owner? I'm assuming that do you have to, if you're the owner, do you have to pay for your roofing? That really is part of your governing documents, and you need to take a look at your governing documents to determine whether you're in a condominium or you're in a single family dwelling, and it'll tell you in those documents who pays for what. Do you have anything you want to add to that, Bill or Mila?
No, thanks.
Okay, so we're good there. Kay Dyack, regular member of ECHO's webinars, put in there the Secretary of State's website. I would
Thank you.
refer you all to that. Thank you, Kay. We appreciate that, and you can see it. It's right on there. Mark Bedzina writes, the revenue ruling requires applying the excess funds toward the following year's assessments. How is this typically accomplished? We have been crediting the surplus to each member's assessment account as a refund.
Ouch. Well, how this is usually addressed, it's kind of like, I use the word philosophical, but that doesn't quite fit it. It's that when the board is formulating the budget, that they address excess assessments, if there are any, and they don't know, they address excess assessments in that budget. So in other words, they budget for a deficit in some way. So that's how it's addressed. Crediting an owner's account is a way of, yeah, that's refunding the money to them. But in other words, it's also accomplishing the same thing if you budget for a deficit, that you're not going to collect the assessments in the same amount of the expenses that you got. Oh, it all accomplishes the same thing, but the method that you do is not used by many associations.
Okay, well, that's good. So Anonymous got back to me and they said the PPA is a purchase power agreement. So it's to purchase the power back. So that's what that earlier question was. And our final question here is from Vicky Harvey. We have an owner who has an EV station put in using his electricity. Okay. And
so that bypasses the whole issue.
Right. Okay. So any other questions? That was the last question for us. And then I guess what I'm going to do is just move on to our final statements. Thank you so much to all of our faculty today and for conducting this seminar. I want to say I apologize for the sound issues that we had. That doesn't usually happen. We'll work on that for the next ones. And so thank you to our members for coming today and for supporting the ECHO webinars. For those of you joining us today who are not members, you are invited to become members. In 2023, ECHO plans to hold more than 70 online events, 3 in-person educational seminars, and more than 30 in-person resource panels. Further, ECHO is celebrating its 50th anniversary, and we'll have special activities in 2023 throughout the year, including a grand anniversary celebration tentatively scheduled for Friday, May 12th of 2023. Mark your calendars. We hope to see all of our members there. ECHO, members of ECHO receive a vast array of resources for HOA boards and for the homeowners. If you become a community member, your entire community is a member of ECHO and they can attend and participate in our events, including we also include books, articles, and monthly publications chock full of information. You receive access to our growing library of content available through ECHO website, the ECHO website, and the ECHO YouTube channel. This year, we introduced a peer-to-peer learning program through the Board Members Club. You can always call ECHO and speak with someone about your HOA questions and concerns as well. We're always at the end of the line and you can talk to a real person. You can join by going to www.echo-ca.org and clicking on the membership tab. We also have a new professional directory if you're looking for vendors, and I recommend going to that and looking through that. And members, please remember to invite your friends, boards, and especially your management firms and vendors to join ECHO. It is particularly important to grow our membership this year in facing the high inflation rates so that we can continue to support excellent resources and programming to foster a better quality of life in HOAs. Our next in-person event is October 26th, the East Bay Resource Panel and the newly formed Echo Club at Rossmore. We will meet at the Dollar Clubhouse in Walnut Creek to discuss the rising costs and issues related to HOA insurance, including insurance denials, wildfire, water damage claims, and liability insurance. The registration announcement will be sent out very soon. Also, we invite any HOA board member or former board member to join the Echo HOA Board Members Club. The club meets every second Tuesday of the month from 5:30 to 7 p.m. Please join your peers for an interactive learning experience. Our next meeting is October 11th, and we will be discussing the rules and rule enforcement during elections and the holiday season. Next year, we're also going to have a special program to talk about vendors and our professional service providers, and that should be a lot of fun too. Each of the breakout sessions is individually moderated, and it's only board members allowed to participate. If interested, please click on the sign-up sheet provided in the packet or email Patty at pkurzet@echo-ca.org. Once again, thank you to our sponsors who made this workshop possible, and to all of you for attending today and participating. Echo appreciates your investments in education to build better HOA communities.